welcome. This is our 20th year of Baskin Financial, 5th time at the Estates of Sunnybrook. Some of you have been here, I think, for all 5 times, once at McLean House, and I think this is the 4th time in this venue, which we enjoy very much. I was looking back at my notes as to the first time we were here, and it was October 23rd, 2008. It was not a great week to be giving this speech. The TSX had fallen from over 15,000. It was down 42% in 10 weeks, and I was very worried about standing up here in front of my clients, lest people throw things at me or worse. But we all survived the crash of 08-09, and I'm happy to say that I see a lot of faces of people who were here 4 years ago, and we all made it through, and things are better now. And what we're going to talk about tonight is, of course, how we think things are going to shake out in 2013. As always, I'm going to take you through our view of the markets, and with the aid of some very nice, pretty pictures and graphs. And I want to talk for a minute first about a concept that we've started to use as a measuring stick at Baskin Financial. And we're now looking to track something that's called upside capture and downside capture. So what does that mean? Well, today the TSX was up 100 points. For argument's sake, say 1%. If you have 100% upside capture, that means our average portfolio would have been up 1% today. Say the TSX goes down 100 points tomorrow, which I hope it doesn't. If you had 100% downside capture, then our portfolios would go down 1% tomorrow, and we'd be mirroring the index, which wouldn't really get you very far and would make you wonder what you were paying for. So obviously what you want to achieve is a higher upside capture and a lower downside capture, right? What we've discovered is we don't capture 100% of the upside. On days when the market goes up 100 points, probably a lot of gold stocks were up today that we don't own, maybe some junior oil companies or some biotech companies. But we also don't capture 100% of the downside, again, because we don't own those stocks. It turns out we capture 71% of the upside on average, but only 41% of the downside on average. So what that means is if we get a terrific year in which the TSX goes up 20%, our average client might go up 14 or 15%, which is not so bad. But when we get a year in which the TSX goes down 20%, our average client will only go down 8%. In other words, we're more focused on protecting the downside than we are in capturing every last bit of the upside. And we think that's what our clients want, and we think that's one of the reasons that clients have chosen to come with us. So that's one of the metrics we're using now, and we're quite convinced that that's something that we should be tracking, particularly in times such as we've seen in the last year or the last 18 months. As you remember from last year, in 2011, the TSX was disappointing, down 11%. Most of our clients were within 1 or 2% of breaking even last year in 2011. This year, so far in 2012, I think as of today, the TSX is up a paltry 2.5% or something. Most of our clients, and you'll have had your September 30th reports recently, most of the people in this room, I would venture to say, are up somewhere between 5 and 8%, depending on what your asset mix is. In other words, we're beating the market quite handily because we're capturing more than our fair share of the upside, but less than the odds on the downside. So that's our job. So I wanted to say that a little bit about our philosophy. So what am I going to talk about tonight? Our view on what's happening in the economy. And we think the economy is improving, but there's absolutely no question that substantial risks remain. I'm going to talk about the situation in the United States, in Canada, in Europe, and in Asia. And I'm going to finish with our outlook for the capital markets. I'm going to try and do this in half an hour, but I don't know if I can. As always, and this is my sort of all-purpose warning, there's always wild card events, unpredictables, things that you can't see coming that affect the market. And of course, since you can't predict them, there's no point in predicting them. We know that there's a possibility, for example, that the US Congress could become psychotic and lead the US off a fiscal cliff. Almost happened in April or May. We know that there's a possibility of a war with Iran. Don't know what the consequences of that would be. Iran has talked about mining the Straits of Hormuz, where something like 41% of all exported oil passes every single day, and the events would be incalculable if that happened. Everything I say tonight is assuming that none of these wildcard events happen to push us off the track. So, as always, I'd ask you to open up your book, and as I talk, you can look at the graphs. I hope that the print is readable, but I'm going to take you through it anyway. And the first thing I want to talk about is the United States economy. Of course, the big focus of the election going on there right now. And what I want to say is this. Number one, the United States economy has been expanding now for 3 years. Every quarter for the last 3 years has seen positive growth in the United States, but not as positive as we would like, or obviously as the Americans would like. It turns out that the recovery from a financial crisis is a slow recovery. It takes longer than, for example, the recovery after the 2001 recession, which was caused by the dot-com excess, or the 1981 recession, which was a high interest rate recession, which was engineered by Paul Volcker at the US Fed to get rid of inflation. And that was, of course, when interest rates went over 20%. Coming out of a fiscal crisis, a financial crisis takes longer. And one of the reasons is because both governments and people ran up very high debts. And if you look at the graph at the bottom of the page, I think this is a terrific graph to explain it. This graph shows the extent to which people were taking money out of their homes by borrowing against their home equity. And to the extent that that line, the red and blue lines, are above zero, those were years in which people were taking money by borrowing against their homes. And of course, Americans were convinced that their homes were going to be worth more money every year than the year before, so that was completely safe. But what you can see is that at the peak in around 2006, 2007, something like 8% of all personal consumption in the United States, 8% of the money that people were spending wasn't earned money. It wasn't money that people made through their stocks. It was money that people borrowed from the bank against the security of their houses. So a lot of the growth in the economy in those years was artificial growth in that it was financed by debt. And now look what's happening now. What we are seeing now with those red line and blue line below the zero line is the biggest deleveraging of the US economy probably in history, but certainly in the last 80 years. People are actually paying down their mortgages, they're paying off their car loans, they're paying off their credit card debts. Now, for every individual who does that, that's a good thing. Having less debt is unequivocally a good thing. But if everybody in the economy does it at the same time, it makes it very hard for the economy to grow. And if you can say that in 2006, 8% of every dollar that was being spent was money that came out of people's houses, you can now see that 6% of personal income, rather than going to current expenditures, is going to pay off debt. And that's a drag on the economy, and that's why the US economy is not growing strongly. People are spending more money paying off their loans. Eventually, this deleveraging will stop. We certainly don't want to see the excesses we saw in the middle part of the last decade, but what we'd like to see is what you see in the 50s and 60s on the left-hand side of that graph, where personal expenditures are around 2%, around the rate of inflation, and that would be a healthy situation. So that, in a nutshell, is why the US recovery is slow and is going to stay slow for a little while. But if you turn the page, in spite of what you might be hearing in the election, the good news is the American economy has created jobs every single month, net new jobs since March 2010. So that's, I think, 30 months in a row. The American economy has to create about 150,000 new jobs a month to break even. In other words, there's about 150,000 entrance into the labor force every month. If you create 150,000 jobs, the unemployment rate doesn't change much. If you do more than that, it goes down. If you do less than that, it goes up. So you can see that the number of jobs being created has not brought unemployment down much because it's averaged about 180,000 jobs a month. Very, very slow. And I want you to understand one of the interesting reasons for this. If you look at the graph at the bottom, and this is a new graph that I had never seen before, this graph, which is very colorful, shows you participation in the labor force by age groups, starting with young people on the left and going to older people on the right. And what you can see as you go from sort of the bluey purple to orange, that's as people get, as years go by. So if you look, for example, 3 to the right, 65 to 69-year-olds, what that says is that 20 years ago, 20% of 65-year-olds were still in the labor force, but today, almost 40% of that age group is still in the labor force. How many of you have kids who are looking for jobs? They've graduated from university, they're trepidatious about finding a place to work. One of the reasons is the people over 65 haven't left their jobs. 20 years ago, 20% of them were working. Now, 40% of them were working. And the 70 to 75-year-olds, 10% of them were working. 22% of them are still working. So what that has done is it's forced the younger cohorts on the left side of the graph either to get more education or travel to Korea to teach English or do something else. So if you look, for example, at 20 to 24-year-olds, these are new job entrants. For years and years, about 78% of those kids were in the workforce. Look now, 65% are in the workforce. In other words, there's 13% of that age group who in normal times would be in the workforce who can't find a job, not only because of slow growth, but also because the people 65 to 75 have decided to keep working, either due to financial insecurity or other reasons, and they're, if I can put it this way, clogging up the labor force, making it hard for those kids to find jobs. So that's a bad sign overall, and it looks like a persistent trend. I just want to say a couple more words about the US economy. Here's what makes me optimistic about the US economy. Number one, new home sales, which I've talked so much about over the years, after having slumped, and I'm now looking at page 5 at the top. We all know that the housing boom was the proximate cause of the financial and recession in the United States. You can see that new housing sales, which ticked along quite nicely in the 600 to 800,000 units a year range, exploded to 1.4 million units in the mid part of the last decade and then fell off a cliff down to less than 300,000 units a year. New home sales are recovering very nicely. And if you're following the statistics, you'll know that new home sales are rising month over month and are now back up to around 400,000. In other words, back to the low end of the normal range. And one of the reasons this is happening is the nice graph at the bottom, which shows you the inventory of new unsold houses. You can see that 5 years ago, there were 550,000 unsold new homes, and that number has shrunk to fewer than 200,000. In other words, there's no new homes to buy. If you want one, you have to order one to be built. And that's causing a boom in construction, boom in hiring of construction workers, so many of whom lost their jobs. The other thing that's making me optimistic about the US economy on the next page has to do with car sales, another very important part of the US economy. If you look at the red line, cars in the United States are being sold at the rate of 15 million a year. The normal rate before the recession was around 16 million a year, but you can see in 2009 it dropped in half to fewer than 9 million a year. The result of that, by the way, was that the average car and light truck on the road in the United States is older than it's ever been in history. The average age of those cars is now 11 years, and they're in desperate need of replacement. So we're starting to see a boom in car sales, and when car sales boom, of course, all the other industries, steel making, auto parts, everything that goes with cars also booms. So we're seeing that. So put those two things together, housing and car sales, and it seems to me that the United States is going back to a firmer footing. And we're seeing that in retail sales. The blue number is retail sales, including gasoline. The red line is retail sales without gasoline. In each case, you can see retail sales recovered from the big dip in the recession and are now at record levels, indicating that the consumers, in spite of paying off their debt, are spending money again. So, my conclusion, no double dip recession in the United States, and I don't think it really matters if Mitt Romney is elected or Barack Obama is re-elected. There will not be a double dip recession in the United States. Now let's talk about Canada, which, as you know, of all the G20 countries, had the best experience in the recession, lost fewer jobs, had less GDP erosion, kept retail sales at its highest level. Canada's also had a relatively weak but pretty steady recovery coming out of the recession. And if you look at the last 4 quarters, growth has been 0.5% a quarter or 2% a year. What we would like to see coming out of a recession is growth of around 4 or 5% a year. But for the reasons we talked about, we're not seeing that. The big risk that we see to Canada, and which most people see to Canada, comes, of course, from the United States. And if you look at the graph at the bottom, you'll see that in spite of the efforts of every prime minister, at least back to Pierre Elliott Trudeau, in other words, at least 45 years, has tried to enlarge Canada's export base and diversify it, you can see that nonetheless, exactly 72% of Canadian exports go to the United States, which is pretty much where it was 45 years ago when Trudeau was first elected. We can't seem to escape from that. In spite of all you hear about exports to the Pacific Rim and China and so forth, still 70% of the United States. And by the way, if you're worried about the Eurozone and exports to the Eurozone, try and find it on the chart there. And you can see that exports to the Eurozone can go to 0 and it won't have a big impact on Canada. What has an impact on Canada? Exports south. So if we think that the United States is not going into a recession, we don't think that those exports are going to be very badly damaged. Employment in Canada, by the way, not only held up better, but has grown better than employment in the United States. If you look at that simple blue line, courtesy of StatsCan, what you can see is that 900,000 jobs have been created since the bottom of recession. But more important, there are 600,000 more Canadians working now than before the recession. More people working in Canada than at any time in history. The employment rate is high and the unemployment rate is low, very healthy. And you can see that Canadian retail sales, very choppy by the way, have been okay at least the last quarter. Now I want to talk about the role of resources in the Canadian economy. It's all you read about in the paper right now. Are we going to sell the oil sands to China or to Malaysia? Are we going to sell potash to the Australians? Are we going to open up a port on the West Coast to export liquefied natural gas? Everybody focuses on the resources as though that's all there is to the Canadian economy. But I want to tell you that that is not the case. And if you look at this very colorful graph on page 9 that segments the Canadian GDP, what you'll see is that, like most mature Western economies, Canada is a service economy. What are the sectors in Canada that are big and that have growth? Finance, health, education, public administration, and professional and scientific. You go a long way down the graph before you find mining and oil and gas extraction. We think these are the things that drive the economy, and they do on the margin, but that's not what the Canadian economy depends upon, and that's one of the reasons why the Canadian economy was so resilient during the recession, because we didn't stop spending on healthcare or education. Our banks, as you know, somehow managed to breeze through, making $1 billion a quarter each during the entire period. So, commodities important to Canada on the margin, but that's not all there is to the Canadian economy. So if we find a situation in which oil falls, for example, to $80 a barrel, not inconceivable, it's I think $87 a barrel today, down from $100 a little while ago. We already saw natural gas go from $6 or $7 per million cubic feet down to $2.50, in other words, cut in 2/3. We're seeing coal exports stalled right now, iron ore exports. That in itself will not kill the Canadian economy. It will lead to an adverse balance of trade. It will hurt on the margin because you can see on the next page, page 10, that although they're not the whole economy, they're a big part of our exports. And of course, this is what people rail against. They would like to see manufactured goods, automotive parts and machinery be bigger, but in fact, it's materials and energy products that are still the heart of our export industry. So, prices for those will affect our balance of trade, but they will not single-handedly bring down the Canadian economy. My prognosis for Canada, much as we've seen the last 2 years, kind of mediocre growth, steady growth in employment, but no whiz-bang. We're not going to start suddenly growing at 4 or 5% a year, at least until the United States gets itself out of its deleveraging crisis. Speaking of which, we've been reading a lot in Canada about the extent of consumer debt in Canada, now at record levels, something like 160% of personal income. In other words, for every dollar that people earn, they owe $1.60. Not a healthy situation. But I can tell you, as a former banker, that what's important is not so much the level of the debt as how much it costs to service that debt. So with interest rates at record low, if people are paying, for argument's sake, 5% on that debt, that's 8% of personal income going to interest. If the debt was 100% of income and interest rates were 8%, it would be the same. And if interest rates were 12%, as they were 30 years ago, it would be much higher. People will have to reduce their debt levels. Canada will have to delever, much as the United States did. But at the moment, it's not going to cause a recession in Canada simply because interest rates are so low, and as we're going to talk about in a while, they're going to stay low, at least for the next 2 years, if not longer. Boy, do we ever hear a lot about Europe. Europe is a mess. It's not going to get out of its mess overnight, but I don't think it's going to blow up either. So why don't I think it's going to blow up? First of all, if you look at the graph on the top of page 11, you will see that Europe is now in recession again. Recession is defined as 2 or more quarters of negative GDP growth, and you can see that first quarter of 2012 was negative, second quarter was 0, third quarter was negative, and it's quite certain that fourth quarter will be negative. Europe is in a recession. And why is Europe in a recession? I don't know if you caught the headline when the International Monetary Fund announced that, to its amazement, it found that austerity was bad for growth. Wow. When I was studying economics, I think the first day of class in 1969, we were taught the concept that demand comes from people spending money, and if you stop them from spending money, there'll be less demand and less growth. That's not only Economics 101, that's first day of Economics 101. So that the IMF didn't understand that by telling Greece and Portugal and Italy and Spain, you must spend much less money, that they would precipitate a recession, beggars belief. Of course it was going to cause a recession. It was always going to cause a recession, and unless they put the foot on the gas a little, the recession will get deeper. You cannot go from massive government stimulus to massive austerity without causing a drop in demand. And I think the IMF now realizes that it pushed too far, and we're going to see a little bit of pulling back on that austerity brake to let those economies recover. You cannot have a society with 25% unemployment. People won't stand for it. So we're going to see that recover a little bit. And if you just look at where the pain is in the EU at the bottom of page 11, it's the countries that you know primarily: Portugal, Italy, Spain, UK, which, by the way, seems to have pulled out of the recession because the Tories there realized that their austerity had gone too far and reversed it. Not the countries of Northern Europe, Germany, Netherlands. So turn the page. That's an ugly graph, the unemployment rate in Europe, and probably still rising. But what I want to look at is the bottom of the page, which is the European balance of trade. One of the things that has happened, and one of the things that the International Monetary Fund and the European Central Bank want to happen is for the value of the euro to go down, particularly against the US dollar, so that European exports can rise. If the euro goes down, goods made in Germany or Belgium or Netherlands or wherever become less expensive and therefore sell better in North America and other places. And you can see that in spite of the recession, the European balance of trade has turned sharply positive because of the euro going down. And my view is that the euro will continue to go down. And one of the reasons is, if you look at the next page at the top, inflation in the Eurozone is running at a considerably higher rate than inflation in North America. And again, this is something the International Monetary Fund wants to happen. Why? Because it makes it easier for countries to pay off debt if there's inflation. If there's inflation, your debt stays the same, a dollar or a euro stays a euro, but everything else goes up in value, including wages, and the value of money becomes less. It's easier to pay off debt. So the plan the International Monetary Fund is using to save Europe, although they're not allowed to say so, they want inflation, they want a lower euro, and they want the European Central Bank to become the buyer of last resort for sovereign debt. And this is the most important graph of the section on the bottom of page 13. This is European Central Bank lending to Italian and Spanish banks. What you see here is the European Central Bank stepping to the plate in the same way as the US Fed did to save the monetary system in these troubled countries. And the European Central Bank will be buying bonds of Spain and Portugal and Italy in order to ensure that interest rates on those bonds stay down and there isn't a crisis of confidence. This, again, is very similar to what the Fed is doing in the United States with its current stage 3 quantitative easing. And what's more, ladies and gentlemen, it's working. Interest rates on Italian bonds, Spanish bonds, Portuguese bonds, Irish bonds have come down from the peaks we saw 6 months ago when people felt that the Eurozone could not be saved. This is an administrative solution that has actually worked, and the European Central Bank has to be congratulated for that. So my view on Europe, not going to implode, not going to fall apart. Greece may or may not stay in, but the rest of Europe is going to hang together. I think the recession there will run its course during 2013, and we'll start to see some serious growth happening after that. But I think you're going to be reading a lot less about Europe a year from now than you are today. Finally, I want to talk about Asia. Asia has been the engine that has been pulling the world economy out of recession for the last 3 years. China and India in particular, but also the Philippines and Indonesia, big economies now. If you look at the graph on the top of page 14, you'll see that the Chinese economy, which is the one in red, is now bigger than Japan, bigger than Germany, much bigger than Germany and France. And if you look at the graph on the bottom of the page, many economists believe that the Chinese economy will be bigger than the American economy in around 2020, 8 years from now. This is remarkable. This is such a change in world growth patterns, really in the entire history since, I guess, about the 16th century. China is becoming the story. India to a lesser extent, but all of South Asia is becoming the growth engine for the world. So Chinese growth, which you've been reading about in the paper, had been running around 8 or 9 or 10% a year, has cooled to 6 to 8% a year. This has been engineered by the Chinese government, who are worried about inflation getting out of control. 6 to 8% a year in an economy that size, it's not bad at all. We can live with it. The Chinese balance of trade, still huge. China is still by far the world's largest creditor and is still locking away hundreds of millions of dollars a year in foreign exchange because its balance of trade is so big. China's working to increase its domestic demand, get its consumers spending more money so it can balance its trade, because it recognizes that this level of imbalance is unhealthy and in the long run unsustainable. In order to do that, it has to have more wealthy citizens, so it's working on that to some extent successfully. Take a look at the graph on the top of page 16 to get an idea of what's happened with those two giant Asian economies over the last few years. The thin gray line is the combined share of world GDP of China and India. And you can see that in 2005, that was about 7% of world gross domestic product. If you look at where it is now, it's almost doubled in 7 years. The share of, say that again, of the entire world economy, the share accounted for by China and India has almost doubled in only 7 years. It's remarkable. When I say those are the engines driving world economic growth, you can see it graphically there, going from 7% of GDP to 13% of GDP in less than a decade, nothing less than remarkable. And that's with India, by the way, growing rather more slowly lately. There's a lot of problems in India that have to be solved, having to do with infrastructure and impediments to employment and so forth. But when I say it's driving the world economy, I thought I'd look at some commodities to show you what I mean. Take a look at page 17, the imports of coal by country. Look at China in 2006, 42 million tons of coal. In 2010, 195 million tons of coal, and 16% of all the coal in the world. And South Korea and Japan right there with them. Look at the graph at the bottom. That blue section, in case you can't read it, is China, and it's taking 45% of all the iron ore in the world. 45% of iron ore. Think about that. Where does steel come from? 45%. And if you add Taiwan, which the Chinese would do, you get to more like 56% of all the iron ore in the world is being consumed by China and Taiwan. Take a look at the next page. We know that the Chinese diet has improved and the Indian diet has improved, but not because of what's happened in China. China was a net exporter of corn. As recently as 2002, you can see 16 million tons exported from China, now a net importer of corn. Look at soybean imports. Only 10 million tons 12 years ago, a couple years ago, 50 million tons. China is now, along with all the industrial commodities, a big importer of foodstuff. And the one at the bottom is concrete. You can't build everything in the world without importing Portland cement. And you can see China's up there in the top left. The only two countries that are way off the graph are China and Saudi Arabia. Saudi Arabia because of oil money. But China's importing an enormous amount of cement per capita, and they're using that to build stuff. So, China, when you read in the paper, Chinese growth threatens the world economy, it's absolutely important that China continue to grow, but it doesn't have to grow at 8 or 10% a year in order to keep doing what it's doing. And as the economy in China gets bigger, 6% of a bigger number is still ample. As India's economy gets bigger, 4 or 5% of a bigger number is still ample. Asia will continue to be the driver of the world economy for at least the next half decade and maybe longer, and will continue to be the destination for exports of raw material, including from Canada and from the United States, even though it's still not Canada's biggest export market by far, but it sets the prices. If the Chinese decide not to take coal, coal prices plummet. If they decide not to buy potash until the spring, potash prices plummet, and Potash Corporation of Canada gives a profit warning. But we know that they're going to import that potash because they need it, because they have to feed all those people, and because they're now net importers of food. So, let me sum up those 4 sections that I went through rather quickly, the entire world, really. The United States, no double-dip recession, slow recovery because of deleveraging. Canada, held back by its dependence on the United States, but steady employment growth to now record levels. Nothing really bad is going to happen here. Europe will hold together, has a lot of structural problems, but the actions taken by the European Central Bank and the International Monetary Fund, a little over-enthusiastic on their part, have worked. They've stabilized the situation in Europe, and nobody's talking, well, some people are. Most people aren't talking about Europe falling apart for the moment, and China, as we just talked about, okay. So the world situation, absent wildcard events, not great, but not bad. I don't expect anything really bad to happen in the world in 2013. 2014 we'll talk about next October. So that's the macroeconomics part. I now want to talk about the part that more people are probably interested in, which is what's going to happen with your money, and where should we put it, and what are interest rates going to do, and what are stocks going to do. There's a joke told about Albert Einstein arrives at the gates of heaven, and he's met at the golden gates, the pearly gates, and St. Peter says, "I'm sorry, your room's not ready. You're going to have to go to a common room and wait for a few minutes. But there's some nice people there, you'll be fine." He goes to the room, and the first person comes up and says, "Albert Einstein, my name is Fred. I'm an enormous admirer of yours, and I have to tell you I have an IQ of 180. Einstein says, "Fabulous, we can talk about abstract mathematics." The guy beside him says, "My name is Jim. I only have an IQ of 150. Einstein says, "Fine, we can talk about physics." The next guy says, "My name's David. I have an IQ of 120. Einstein says, "That's fabulous. We can talk about the Blue Jays." And the last guy says, "My name is Don, and my IQ is 80. Einstein says, "So where do you think interest rates are going?" Which is all by way of saying that forecasting interest rates and stock prices is a bit of a fool's game, but I do it every year. So let me talk about what I think is going to happen. Number one, we have more certainty right now about interest rates than people have ever had, because the central bankers of the world have made it their job to give people long-term certainty. They no longer forecast 3 months or 6 months. The Fed says interest rates are going to be low until at least 2015. And the Bank of Canada says interest rates are going to be low till at least 2014. This expectations game plays a very important part in how people act. Because if you're a business owner and you know that money is going to be cheap, it might make you more willing to invest than if you think interest rates are going to skyrocket. It has an important part to play, and the central bankers now understand this. So we know that nobody is going to pay you to hold cash for at least the next 2 or 3 years. They're going to pay you what they're paying you now, which is 75 basis points, or maybe 1% if you're lucky. Nobody's going to pay you to hold cash. And what's more, nobody's going to pay you much to be in long government bonds. You can buy right now long Canadian bonds. If you look at the chart here, and the 10-year Canadian bond is the sort of reddish one, under 2% to loan the government money for 2 years. You get your 2%, you give the government back 1% for interest, you have inflation of 1.5%, you would have been better off burying the money in the backyard. But that's the way it's going to be for probably at least the next 2 years. Fixed income, unrewarding, and we don't see that changing. So what do you do about it? Well, one of the things you can do about it, of course, is not buy government bonds. You can buy corporate bonds instead. You can buy preferred shares instead. You can take a little bit more credit risk in order to up your returns, and we'll talk about that in a minute. But by and large, fixed income, unrewarding. You still have to have it in your portfolio because it's stable. And if we get one of those wild card events and the stock market decides to plummet, you won't mind that you're only making 2% on your bonds because they're not going to go down like stocks might. So we still need it as stabilizers, but we know we're not getting rich from bonds. And I can't leave this section without giving a plug for real return bonds. That is to say, bonds that the government issues, which are pegged to changes in the consumer price index, and as inflation increases, the payments on those bonds increase. They're a terrific instrument, and we buy them for almost all our clients. US bond yields on the next page, page 20, much the same story, except less even than Canada, with the 10-year Treasury in the United States well under 2%, very unrewarding, and US inflation is higher than Canadian inflation, so you're falling behind even further there. So we don't see any money to be made in bonds. We think people who hold long bonds are taking a risk for very little reward. we're keeping our maturities short, and we're buying corporate credit rather than government no-risk bonds. If forecasting interest rates is a fool's game, forecasting currencies is for total fools, I guess. But nonetheless, I do that every year too. So I'm going to talk about that for a second. We think the Canadian dollar is going to trade in a pretty narrow range this year, mostly above par, might get up to $1 and a nickel. If we see something that causes oil prices to go higher, Canadian dollar could go up to $1 and a nickel. I don't think it's going to go much below 98 cents under any circumstances. And what that means is that for Canadians, the currency risk involved in investing, for example, in the United States is quite muted. You'll remember a situation 10 years ago that if you owned American stocks when the Canadian dollar was 65 cents, you took an enormous beating because the Canadian dollar went from 65 cents up to par, and all of a sudden your US stocks were worth 50% fewer Canadian dollars. Canadians invested in the United States took an enormous kicking even as the stock market rose. We don't see any prospect of that level of currency risk in the present circumstances vis-a-vis the United States. But as I talked about, the situation in Europe is different because we think there's a concerted effort to take the value of the euro lower against the US dollar and therefore also against the Canadian dollar. So if we were, for example, to go out and buy a stock denominated in Europe, Unilever, the big multi-branded company, or Tesco, the British department stores, or BP, we're taking a significant currency risk, in my view, so that even if those stocks do quite well, for Canadian investors, the depreciation of the euro against the Canadian dollar might take all those gains away. So we're being very wary about investing in Europe this year. The euro is currently worth about $1.30 US. We think it could go down to $1.20 US. That's a fairly significant decrease. And if Canada goes up a little against the US dollar, the drop versus the Canadian currency could easily be 10% or more. Canadian stocks. The winning recipe for Canadian stocks in the last little while has been dividend payers and dividend growers. Playing commodities has turned out to be a bad idea. The volatility has worked against you. The lack of good dividends has worked against you. Dividend payers and dividend growers. And who are those companies? First and foremost, the banks. Secondly, the telecoms. Third, the utilities. Fourth, the pipelines. These are the stocks that have rewarded Canadians, and in our view, boring as it sounds in 2013, will continue to reward Canadians by giving not only solid income in an environment where bonds are very low, but also solid capital gains, albeit not huge ones. So, stick to what we've been doing before. Banks, telecommunications. Insurance companies remain a bad risk, by the way. Don't confuse them with banks. Remember that insurance companies make most of their money by investing premiums in bonds. And if bonds are lousy, insurance companies cannot prosper. Do not confuse insurance companies with banks. Totally different business, though they're both in the financial sector. And by the way, digression. Why don't we like exchange-traded funds? If you buy, for example, an exchange-traded financial sector fund, you get the banks and the insurance companies. You get the good and the bad. What's the point of that? That's why you hire me. Real estate investment trusts have been a good investment the last couple of years because of the solid income that they're providing. They're expensive now. The easy money is off the table there. Some of the smaller ones, some of the ones that we've been buying for clients, still offer a good return. We're going to continue to look at those. Metals and minerals, unattractive, as we said, because of the volatility. Agricultural commodities, a very interesting sector. World grain stocks at record lows as a result of the drought in the United States. Big Canadian retail facing challenges. Target is coming to Canada. Nordstrom's is coming to Canada. Marshall's. Tough to be a big retailer, but if you're in a niche like Shoppers Drug Mart or Tim Hortons, we think you can still make money. So, Canadian stocks, much better alternative than bonds. Pick your sector. U.S. stocks, Some people say they're expensive. If you look at the graph on the bottom of page 22, what you can see is the price to earnings ratio of the 500 biggest companies in the United States, the S&P 500. Well, that looks to me like they're trading kind of at the low end of the last 20 years, at around 13 times earnings. Earnings is not great in the S&P 500. We're seeing a lousy quarter for earnings, but it's not like you're buying those companies at 25 times earnings. You're buying those companies, Apple, which reported today, I think 12 times earnings after cash. I'll buy Apple at 12 times earnings all day long. So if you're selective, there's still good gains to be made. We believe in technology. We believe in some of the American banks, which are now becoming more analyzable. We're starting to understand their balance sheets a little better, and we're starting to see where we can make money with American banks. Branded products companies like Procter & Gamble, which reported earnings today, and very good earnings, still have a worldwide franchise, but will be hit by the low euro, by the way, to the extent that you repatriate profits from Europe. If the euro goes down, those profits are less. But there's opportunities there. Healthcare-related companies, again, whoever wins the presidency in the United States, healthcare spending continues to rise there, and there are no Canadian healthcare companies that we can buy that are comparable to US ones. We don't think manufacturing is a great place to be in the United States. We're going to de-emphasize that sector. So we think there's stocks you can buy in the US as well as Canada. Most of you have seen that in your portfolios, if you've been with us a while, going into the recession in 2008, we had cut our US portfolios to the bone, and when the Canadian dollar went down to 75 cents in the winter of 2008, we sold all of our American stocks, brought that money back, converted it to Canadian dollars at $1.30, and we've only started to go back into US stocks last year. Most portfolios now have between 10 and 15% US exposure on their stocks. We're probably going up to 20, perhaps even a little bit higher than that, as we see opportunities, and particularly at times when the Canadian dollar is above par. Finally, at the very bottom of page 23, there's a little chart showing why stocks are so much more attractive than bonds. It simply compares the dividends to the after-tax yield on bonds, shows you the spread, and it also shows you the dividend growth on those stocks. Of course, when you buy a bond, the interest rate stays the same. It doesn't change. So, ladies and gentlemen, that's my outlook for 2013. Putting it in a nutshell, we think we can make money in stocks. We buy bonds for defensive purposes only, not because we think we're going to get rich. We're going to be careful about Europe, but we're going to be more aggressive in the United States. We see the world being relatively benign and certainly not as bad as the headlines would lead you to believe. Thank you very much.